Good morning. We have, how many before? Well, one of them might be the host, so you have three. So I don't know how you. Christine?
I'll just tell them we start. Just.
And Joey said he can't log in.
Okay.
He's muted. She muted.
Yeah, I'll be muted for most of the session. I'll talk when I can though.
Okay, sorry about that.
How you doing? What's up? There was about 7 or 8 people in here, but people were leaving.
Okay, welcome everyone. Can everyone hear me okay?
Yes.
Perfect. Thanks for your patience. We'll go ahead and get started. All right, so we're going to talk about mortgage hacks playbook today. My name is Rob Norwood. I'm the mortgage guy with Keller Mortgage. And if there's any questions, we'll if you could just type in your comments, I'll try to do a good job of looking for the comments. Unfortunately, there's no clicker, so I have to use a mouse. So bear with me here. The first thing I want to talk about is understanding the market of the moment. So basically, there's a few things that this is going to cover. Understanding the most impactful issues that are keeping clients from transacting in your local market is imperative so that you can develop and offer solutions that lead to transactions. So the first thing is you just ask them. And then the second item is data is abundant, and then local and national events. So we're going to dive a little deeper into this. So when it comes to thriving in the mortgage market of the moment, in Q4 2022, the National Association of Home Builders stated that home buyer sentiment hits its lowest level since 2011. When asked to identify the top reason for the decline in sentiment, consumers cited the current rising interest rate environment along with forecasts of continued rate increases. So in order to best serve their customers, real estate agents need to assess their current lender partners' effectiveness to operate in this higher rate environment, as well as get educated on the myriad of programs available designed to assist both buyers and sellers who still wish to transact at the most favorable terms. So passengership versus partnership. Let's talk about that for a minute. Passengership, so basically there's 2,907 active homes on MLS, 10,000 active agents. So what that means is when the real estate market is strong, it almost feels natural for vendors and allied resources to become passengers. So imagine the transaction as a school bus and the real estate agent is the bus driver. Once a contract for a buyer or seller is signed, the seats begin to rapidly fill up. Home inspectors, lenders, title executives, lawyers, escrow officers, movers, homeowners, etc., are more all climbing aboard. Suddenly, all these service providers are needed by the consumer, and each of them gain a new customer. However, none of this is possible without the real estate agent having generated and converted the lead into a transaction. In a strong market, that's okay because there's enough business that's simply getting good service from your vendors is enough. But then the market shifts, and the activity it takes to secure a buyer or seller, as well as the cost of leads and appointments, double or even triple, meaning less transactions. It is at this moment that their vendors need to be moved from passengership to partnership. So let's talk about partnership. Partnership is providing market-specific information and market support to aid you in converting buyer and seller leads into clients, as well as marketing to your clients. Partnership provides direct financial support to you in a respite-friendly and compliant way. By creating new customer-focused programs that match the needs of the market and cause more transactions to happen today. Because mortgage rates are at the forefront of their current market shift, the rest of this playbook will focus on some of the programs and hacks that real estate agents, along with their lender partners, can use to turn mortgage programs into a timely and powerful value add. So when the market changes, your partners should realign their value propositions to help support the acquisition of new customers and provide enhanced services to existing customers. So Keller Mortgage Loan Solutions. So Keller Mortgage and Rob, the mortgage guy, is a trusted loan solution and product advisor. So at Keller Mortgage, we do offer several products that hopefully you're familiar with. If not, I just want to go over a little quickly here. So we have conventional loans. So the conventional loans, that are Fannie and Freddie backed. We also offer USDA loans, FHA, manufactured, first-time home buyers. And I want to touch on the first-time home buyer loans because a lot of people don't understand that because you're a first-time home buyer, there's definitely different benefits that we offer. So for instance, there may be a slightly better rate. There may be slightly lower down payments. So there's different solutions like Home Ready, Home Possible that first-time home buyers can take advantage of. And in addition to that, a lot of the first-time home buyers don't necessarily have to be first-time home buyers. It's just a matter of how long it's been since they own their existing home. So Definitely reach out to me if you have a first-time home buyer, somebody that may be eligible for the first-time home buyer products. Definitely reach out to me and I'll, definitely give you some information there. We also offer jumbo loans. And then VA, refinance, condo loans and condo tel loans. So we offer a lot of different products that I can give you more detail about. And then let's talk about mortgage product hacks. So this is the product hacks we're going to talk about today are seller contributions, temporary buy downs, seller funded permanent buy downs, ARMs, adjustable rate mortgages, 0+ products, offer ready products, lock and shop, and seller assurance. So let's talk about seller contributions, and let me just make sure there's no questions at this point. All right, perfect. All right, so how it works, seller concessions are interested party contributions, IPC, our closing costs that the seller agrees to pay. They can also be paid by interested parties like the builder or developer, the real estate agent, broker, or any affiliate who may benefit from the sale of the property. The table below reflects the max concessions for conventional type mortgages. So if you look at the table below, the loan type, conventional, property type, primary and secondary home, and the down payment would be less than 10%. Then there's a max seller contribution of 3%. 10 to 25%, the max seller contribution is 6%, and so on and so forth. So, as you can see, when it comes to seller contributions, there's a lot of things you could talk to your buyers about as far as seller concessions and taking advantage of that. Because right now in the market we're in, a lot of sellers are willing to kick in for seller contributions, lower the rate, do the buy down, as opposed to lowering the purchase price of the home. So it's a win-win for the seller and the buyer. Again, the seller contributions are more common in a buyer's market and can give the buyer more bargaining power. It also reduces the buyer's total cash to close and can allow for additional funds for improvements and repairs. The sellers can convey personal items like leaving the media room fully equipped or passing along kitchen appliances. Let's talk about temporary buy down, seller paid. So how this works, the seller or builder can fund a buy down account, and a portion of the account is used to reduce the buyer's monthly payment for a certain period of time. So in this example, we have a loan amount of $400,000. The rate is 6.75. The term is for 30 years. So you can see in this illustration below, year one, instead of the rate being 6.75, it's reduced by 2%, which is 4.75 for the first year. So the monthly payment will be $2,087. The monthly savings would be $507, and the yearly savings would be $6,084. Now we go into year two, the rate increases only by 1%, so the new rate is 5.75. So the monthly payment goes to $2,334. The monthly savings is $260, and the yearly savings is $3,120. So in year three, the rate goes to the initial locked-in rate of 6.75, and the monthly payment goes to the regular payment for the next 30 years. So the seller paid buy down is something that is happening a lot now. I'm seeing that a lot, especially for homes that have been on the market, close to 30 days. Usually the sellers will, want to do something to get the house to move. So one way of doing that is to offer seller paid buy down instead of reducing the purchase price. So that's something to definitely keep in mind. Seller funded permanent buy down. So again, this is something else that's pretty beneficial. A permanent buy down lowers the interest rate for the entire term of the loan. Motivated sellers will occasionally offer to pay for points to lower home buyers' interest rate, which helps them qualify for the loan. So again, on a permanent buy down, it could help somebody qualify. On a temporary buy down, that would not help someone qualify because it's temporary, meaning the rate would go back up. But on a permanent buy down, that rate is permanent, it's not going to change. So that's the difference of why you can, a buyer could qualify with a permanent buy down as opposed to a temporary buy down. Again, the benefit, the buy down reduces the buyer's principal and interest for the life of the loan. So it's a great negotiation tool whereby the seller can keep their desired listing price of their home, yet make the property attractive to buyers. All right, so the next thing we're going to talk about are ARMs, adjustable rate mortgages. Sorry about that. How it works, an ARM is a type of adjustable rate mortgage loan with a fixed rate for a portion of the loan term, after which it switches to an adjustable interest rate for the remainder of the loan term. Now, as of right now, I just had this question yesterday. You know, I'm getting more and more people that are interested in ARM loans. However, as of right now, the ARMs, like 5-1 ARM, I mean, the rate is just comparable to a 30-year fix. So, you know, if you do the math, in 5 years, more likely you want to refinance out of it. Well, the only way the ARMs are really beneficial if the rates are significantly less than the fixed rates, which they're not. So that's something to keep in mind. I mean, if it's just like an eighth lower, it doesn't really make sense to go with the ARM program because it's not going to save the client money. So just something to keep in mind. All right. So because Keller Mortgage and Keller Williams work closely together, we do offer agents the 0+ loan. So what this means is the 0+ loan, there's 0 origination fees, 0 processing fees, 0 underwriting fees, and there's $1,000 closing credit. So the loan amount must be at least $150,000, and the upfront savings is about $2,300. So this is definitely a benefit for your client and something that you definitely want to take advantage of. And then if there's the one thing also to keep in mind, when you send me a client, I will definitely look at all available products, including the 0+ if it makes sense, if it's going to save the client money. Sometimes the 0+ loan, the rate may be slightly higher, so it doesn't make much sense if you have clients that don't have any issues coming up with down payment funds. So just something we can kind of walk through when it comes up. Another product that we offer is the Offer Ready program. So this is kind of nice because this allows your client to gain the competitive edge over the buyers. Over other buyers with a fully underwritten pre-approval. So what that means is once I do a pre-approval for this program, I send it to the underwriting where it's fully underwritten. So there's no mishaps, there's no uncertainty. We don't have to, worry about, while we did something came up in underwriting. But I can tell you right now, I've been in this business for 20 years. I've been doing this for a long time. So I'm pretty good at looking at clients and looking at their specific situations and uncovering red flags up front before it even gets to underwriting. So that's just something that, when you use me as a preferred lender, that my experience kind of helps with that as well. So, but this is another program that we do offer. We do offer a lock and shop, and the Keller Mortgage Lock and Shop is pretty strong because most lenders' lock and shop programs requires the client to put money down, and it could be up like to $2,000. Where we don't do that. We don't require any upfront fees to be paid, which is huge. So the lock is good for 120 days. So if we're in a market with rates which is fluctuating constantly, or maybe they go down significantly, and you have a buyer that is pre-approved and wants to lock in a rate, we can certainly do so for no fee. All right, seller assurance, and this is something I want to talk about. It doesn't come up too often, but we do offer this. Cross-qualifying is used to give peace of mind to home sellers in an environment where other lenders do a poor job of pre-qualifying in order to win new business. So again, there's a lot of lenders out there, as you guys know, Some loan officers don't have a lot of experience, which no one ever tells you. And we all have unique identifiers. I have one which is 192369, 6 digits. So we all get unique identifiers once we get into the mortgage industry. So you can kind of tell by the experience by that unique identifier. So the longer the number, the less experience they have. So just something to keep in mind. Seller assurance is not beneficial on every listing, and it's up to the agent to determine if a property is a good candidate for a seller assurance. Simply require any buyer who would like to make an offer submit it for pre-approval with the seller's lender of choice for further verification before accepting an offer. Benefits to the sellers: this offers the seller confidence that the offer will not fall through for financing reasons, and allows the agents to further establish their lender partnership. All right, hacks for current homeowners. Let me just check and make sure there's no questions in our chat. All right. All right, current homeowner hacks. So a couple things I want to talk about. There's number one is early payoff hacks. And then we're going to talk about the HELOC, how to remove PMI, house hacking, refinance to a shorter term mortgage, and also make payments with a cashback credit card. So let's dive a little deeper on these topics. Early payoff hacks. So if you make one extra loan payment each year, you could essentially save a lot of money and also pay off your mortgage earlier. So, and a lot of you probably already know this, but it's just kind of good to, this is something you can, talk to your clients about. And this is like just showing your clients you have a little more knowledge than than someone else, another agent. So, by being a little more helpful and just kind of giving them some extra tips. So by making it one extra payment per year, homeowner can reduce the amount of interest they will pay over the life of the loan, as well as shorten the term. So in this example, the monthly payment is $3,160. So by making one extra monthly payment of $3,160, the mortgage would be paid off 6 years ahead of schedule, and the net over of $156,000 in savings. So it's pretty huge. So if you look at the graph, 30-year loan and one extra payment, I mean, total interest paid, if you just paid a regular monthly payment, is $662,000 as opposed to $506,000. So you're essentially cutting 6 years off the term. So that's just making an extra payment. So there's different ways to do this. So I always tell people, you can go online. This could be with your car payments. This could be, with a lot of other things. And there's free amortization schedules online that you can download and kind of plug in your numbers and see, by making a half payment, extra payment, how soon you can get your the debt paid off, including the mortgage or car. All right, so early payoff hacks, round up the payment. So another one is by rounding up a monthly payment of $3,160 to $3,200 every month, $32,000 will be saved in interest, and the duration of the loan will decrease roughly by 2 years. So this is simply just by rounding up. So as you can see, I mean, that's $32,000 in savings just by rounding up, which is huge. So a lot of people know this, but until you see it on paper, it doesn't really stand out. But when you start looking at these things on paper, it's huge. So one of the things I do for every client that I work with, I do a total cost analysis of their mortgage payment and different programs, products that they can qualify for. And some of this stuff is just part of that total cost analysis. So that's definitely a tool that I do use, that I like to use to show people different examples of just being, mindful and smarter when it comes to the mortgage. Home equity line of credit is also known as the HELOC. Is a line of credit secured by the home that gets borrowed a revolving credit line. So I've had plenty of people that need money and, and they come to me and say, hey, Rob, should I refinance? The first thing I ask them is what's the rate, how much do they need? Because, based upon that, it may make sense just to get a home equity line of credit instead of refinancing, especially if your rate's like 2 or 3%. So, that's something to keep in mind, that, you know, if you have clients that ask you about that, you can definitely refer them to me, but, put this also in your toolkit as well. How to remove PMI. So, you know, back in the day, I would say, you know, 10 plus years ago, everyone was like, no, you don't want to pay PMI. It's ridiculous. It's just throwing money away. Well, yes and no. So the way I look at PMI, first of all, the PMI rates have come down considerably over the last 10 years. So, you know, you don't have many people putting 20% down anymore. I think honestly, in my opinion, I think 10% is a good number, if you can, because the PMI is pretty low. And the way homes are appreciating nowadays, I mean, you're looking at maybe PMI for a year, maybe 2 years, and then it automatically drops off at 70% loan to value. And at 80%, you can actually ask your lender to see if you can get it taken off. So I don't shun people away from paying PMI, because I think if you look at $10,000 as opposed to $30 a month PMI payment, it doesn't make sense to put that extra money down. So the cost of PMI for conventional home loan averages from 0.58% to 1.86% of the original loan amount per year. Again, if the borrower has an FHA loan and 20% equity, they can refinance to a conventional loan and get rid of the FHA mortgage insurance premium. Because as you know, FHA, you no longer you pay that PMI for the duration of the loan. So a good way to get rid of that is just to refinance into a conventional loan. All right, let's talk about house hacking. So by purchasing a multi-unit property, a borrower can live in one unit while renting out the rest. The rent counts towards a borrower's income, which could help them qualify for a larger mortgage. So the one thing that I like to tell my clients is that, you know, especially if they're looking for a multi-unit property, that they don't need to necessarily make the kind of income in order to qualify for all 4 units. Because what we will do is we'll have an appraisal done and use the rents in that area to help qualify. We can use up to 75% of the rent to qualify, help them qualify for that property. So you'd be surprised that I've done a lot of 2 to 4 unit properties, you know, with borrowers who have, like, I would say average income, but using that rental income really helps them qualify for that mortgage. So definitely something to keep in mind.
Okay, quick questions
Yes.
on that.
Yeah.
So does that rental income qualify just immediately for the purchase of that property, or is there a seasoning?
It's immediately.
Okay,
Yep.
so if they've never owned a rental property before, they can use that rental income as.
Yep, yeah, they can use that to qualify for the purchase of that property. So what happens is, and that's something we have to get up front. So when the appraiser goes out, he's gonna have to put the rental income for that area.
Right.
And include that in the appraisal. So
Okay.
we then use the 75% of that rental income to qualify that.
Okay.
Yep, good question.
Because I know some lenders, they'll say, oh, they'll use it, but you
Yeah.
have to have been maybe a landlord for a year.
Yeah, no,
Okay,
No.
that's cool.
No.
That's very cool.
oh yeah, absolutely. Good question. All right, so refinance to a short term. If a borrower can afford a higher monthly payment, they can refinance their 30-year mortgage to a 15-year mortgage, which helps them pay off the mortgage faster. These shorter term mortgages also offer lower interest rates. So a lot of times people don't understand, the shorter your term, the lower your interest rate. So if someone can afford a 15-year term, the rates are typically better. But just something to keep in mind. I mean, you know, I don't see a lot of 15-year term mortgages anymore. I see majority 30, but it's out there. I mean, you can do a 10-year term as well. All right, so another hack is make payments with a credit card. And this is a true hack. So most lenders do not accept credit cards. However, some lenders are now accepting PayPal, and a borrower can set up a PayPal account, link it to their credit card, and make their mortgage payment from PayPal. Now, this allows the borrower to earn the cash back or points, which are often redeemable for cash and rewards with certain credit cards. If the borrower uses the cash back gain, they could help pay down the loan faster. So that's another hack that a lot of people do not know about.
Yeah, that's very cool.
All right, let's talk about Keller Mortgage loan programs. So we do offer the lock and shop that we talked about earlier, the 0+ program, the 2-1 buy down, and also the offer ready. So I know we went over that a little more, so I'm just going to kind of keep going through that. There's some marketing hacks, and this is where you as a real estate agent definitely want to put this on your social media, put some of this stuff out there, try to earn some more clients, run social media ads, partner with me, Keller Mortgage, or Rob, the mortgage guy, create an email database, display on your website, link your social posts to this page, co-host a seminar with a lender. So these are different marketing things you can do to kind of really just generate leads. And every 2 weeks, I think I did the first one last Thursday. We're going to do it every other Thursday. And this is lead generation. This is something that is new. We're really just kind of getting this off the ground, but this is a great way to bring some of your leads to the meeting. We're going to talk about some role play things. I kind of use my experience. When I first started, I think in 2001, we didn't have all the internet leads. We didn't have Zillow and all this stuff. What we had was cold leads, and you had to make them warm. So there's a lot of things, a lot of conversations. There's different things you can do, methods, techniques that we're going to talk about in this lead generation training. We're also going to do live calls. We're going to see how things work. We're going to kind of network as agents and talk about what we find helpful, the tools we use, and even some of the sites that we get leads from. Are they worth it, right? I partner with several different real estate agents over the past years and, co-marketed. So I know different sites that work, which ones don't, the percentage you get back. So all that stuff we're kind of going to take a look at, and hopefully that'll help you in your lead generation journey. So hopefully this was helpful to you guys. Let me see if there's any questions in the chat. Doesn't appear that there's any questions. So any questions?
No, not right now. I thought it was very helpful.
Perfect. All right. Well, if no one has questions, I will conclude the meeting. I appreciate you guys coming, and everyone have a great week, and let's generate some leads.
Thank you.
You're welcome.